Namaskara guys, this is Stock Yatra and we are looking at a series of lectures on the basics of the Indian stock market. We have completed 4 lectures so far and we'll be looking at the 5th lecture now, which deals with the settlement and the different terms and vocabulary used in the stock market. We'll dive right into it. So settlement. What is settlement? Settlement is the act of delivering a good or products, right? Just like how you place an order with Zomato, they deliver it to your house. This entire act of delivering a product is what is called settlement. The similarity between Zomato and ZERODHA is that once you place a let us take for example, you place a buy order for a share with ZERODHA or any of your brokers. What So you are the buyer here. What happens here is that you pay money to the seller who sends the shares to you. Now, these acts is what we call settlement. Transfer of money from the buyer to the seller and transfer of shares from the seller to the buyer is what we call settlement. In India, we are following a settlement duration of T plus 1. T plus 1. Here, T stands for trade day or the day when the transaction has been placed. It could be either a buy transaction or a sell transaction. The T day is when the trade has been placed. T plus 1 settlement is being followed from this year, that is year 2023. Before that, initially in the olden days, it was a T plus 30-day settlement because all the paperwork in those days was slow and had to be done physically. That is the reason for such a long settlement period. Now, then it was reduced to T plus 14 days, which eventually reduced to T plus 2 days, and now we are at T plus 1, which is the current settlement period. So T day is the transaction day, and the second day is what we call the T plus first day, is when the money or shares are going to reach your corresponding bank account or Demat account based on whether you have bought or sold the share. If you have bought the share, shares will go to your Demat account. If you have sold the share, money will go to your bank account. This happens on the T plus first day. Settlement of T plus 1 day actually affects your short selling. Short selling, we'll look at it in detail in the next slide, but here short selling generally means sell first, buy later. You are actually selling a product that you don't possess. You are not possessing the product currently, but you can acquire it later and give it to the person you have sold it to. Right? This is what happens in short selling. How settlement is affected is that initially, when T plus 30 days was the settlement period, the broker had 30-day grace period to ensure that after short selling, the seller actually provides shares to the buyers. So there was a period of 30 days for this thing to be occurring. Now, in T plus 1 settlement period, there is only 1 day for the seller to send the shares to the buyers or settle the shares to the buyers. Therefore, short selling has to be strictly squared off in an intraday period. That is, within the closure of the market on the same day. This is how settlement has affected the evolution of short selling, the duration that short sellers get. With this said, there is another concept called BTST, which stands for buy today, sell tomorrow. Here, the advantage was that you didn't have to pay DP charges in intraday and BTST. You don't have to pay DP charges. This is because in intraday and BTST transactions, the shares are not settling in your Demat account. That is the reason you don't have to pay any DP charges. But even today, some brokers are actually charging DP charges for BTST transactions also, but intraday, most of them don't. That was the advantage with BTST. This T plus 2 was actually an old concept, not in use today. Coming to the vocabulary, different vocabulary or jargons used in the stock market. We'll look at the basic to complicated first. So, the first term that is generally used in the stock market is trend. So, just like the literal meaning of the word trend, trend in gives an insight into the general market direction or strength or even performance. Okay. So based on this, we can have three different types of trends. One is the uptrend, sideways trend, and the downtrend. When a market is moving this way, that is rising continuously, it is said to be in an uptrend. When the other thing happens, like it is falling like this, I'm sorry, that's a wrong graph. Yeah. When it's falling like this is what we call the downtrend. The other name for a downtrend is a bearish trend. You would have frequently heard about two terms, bull and bear, in the market. So bull is a synonym for uptrend and bear is a synonym for downtrend. This is derived by the actions that a bull and bear does in a fight. So when a bull is in a fight, with its horns, it pushes the prey or the opponent upwards into the air. It tosses the opponent in the air upwards. So that is how the bull term has been derived for an up move. And a bear uses its paws to hit the prey to the ground. So it tosses the prey or the opponent into the ground or downwards. That is how the down move has been termed a bear move. The next term is a script. So, script is nothing but a synonym for stock name or symbol. It is a synonym for a stock name or a symbol. Tata Consultancy Services has a script TCS. Likewise, each company has its own script. It is just a small abbreviation for the stock name to make it easier for you to search the stock name. We have already discussed what is face value. It was the basic intrinsic value of a share. So, position is nothing but a trade or act of placing a trade. If you are buying a share, it means that you are going long or you are taking a long position on that particular share. Likewise, selling a share is like short selling or taking a short position on that particular share. So long stands for buying, short stands for selling, and it does not have to do anything with the duration. So it is not like you're going short term or long term. Going long on a share means that you are bullish on the share. So you are buying first at low price, selling later at high price. This is going long on the market, and the vice versa is applicable for going short on the market, where you sell first at a higher price and then buy later at a lower price. Next important term is square off. So as we saw, positions also correspond to open transactions. So for example, let us say that you have bought Wipro shares. Let us say you've bought 10 shares of Wipro. Of these, you have sold 5 shares of Wipro at a higher price. Now your position or your holding would be 5 shares of Wipro, that is 10 minus 5. 5 shares of Wipro is in an open position in your holdings or in your Demat account. So this position, open position, whatever is you are having, if you close an open position, this action is what we call squaring off. If you were going long on the market, you would have bought first, right? So your square off action will be to sell. Likewise, if you had gone short on the market, you would have sold first, and your square of action will be to buy later. It is the opposite of what you had done first. That is what we call squaring of your positions. This is a very important term, so don't get confused here. As we saw, holding is a list of all your open positions. The 5 shares of Wipro that we hadn't sold is our holding. Understood? And likewise, there are two terms, order and trade. So order is any open order which has not been executed. Once it gets executed, it converts into a trade. So an order is an open position or an open order which has not been executed, and a trade is an executed order. The meaning here is that you place a buy transaction or buy order for Adani Enterprises share. You want to buy 10 shares at a price of 120 rupees. Let us take a hypothetical situation. And the price of Adani Enterprises share is at 150. So you want to buy it at 120, which is a lower price than the current price. So you place an order, a buy order. Once this share price reaches 120, this order will get executed and convert into a trade. That is the difference between a trade and an order. This price of Adani Enterprises that we saw 150 is what we call the CMP or LTP. It stands for current market price or latest traded price. It is the current or the last price of the share that it was trading at previously. So CMP and LTP was the market price of the shares at that particular moment. So 150 was the CMP of Adani Enterprises. So the CMP came down to 120 rupees. That was when our order got executed and converted into a trade. So CMP at that instant was 120. So CMP can keep fluctuating with every second that passes. The next term that we see here is again to do with prices, OHLC. So O stands for open, H stands for high, low is L, and C for close. Like the name suggests, open is the price that is at the opening of the market at 9:15 a.m. Whatever was the CMP of a share at 9:15 or opening of the market is what we call the open price or O. Likewise, whatever was the CMP at close or 3:30 is the closing price, and whatever was the highest price reached by a share during that time period will be the high, likewise the low. That is the concept of OHLC. It is useful in technical analysis and also determining where your order could get executed, at what price your order that you place can get executed. The next concept is volume. It is the number of buyers or sellers in a market in toto. So it is the total quantity of shares being traded in unit time. So if there is one person, first person, who wants to buy 10 shares of XYZ company, second person wants to sell 5 shares of XYZ company. It is all at the same price. Third person also wants to sell 5 shares of XYZ company. Let us say it is all at the same price. So the volume here will be 10 and not 20 or not 3. So the volume here is 10. The total number of shares that is being changing hands. So 5 shares are bought from this person, 5 shares are bought from the third person. Total 10 shares are being bought by the first person. Only 10 shares are changing hands. First 5 from second person to first person, and the next 5 from third person to first person. So since only 10 shares are changing hands, or 10 shares are being transacted for, the volume will be 10. This is the concept of volume. And bid and ask. Whenever you open a broker account and you want to place an order, it can be either a buy order or a sell order. The broker UI shows you two columns. One is the bid and the other is the ask column. So bid is the word that is used when you bid in an auction. So you are offering to buy a particular product at any price. So ask means that you are offering, you're asking a certain price to offer to sell a product. So bid basically means you are offering to buy at a certain price. Ask is you are asking a certain price to sell that product. So this is the difference between bid and ask. The same thing applies for bid and ask quantity. So if you're offering to buy 10 shares of a company, so you're bidding for 10 shares. If a certain person is asking to sell 50 shares of a company, it means that his selling quantity is 50. Lot size. Now, lot size is an important concept in F and O or derivatives market. It is seldom used in the normal equity market, because in the normal equity market the lot size in India is 1. So the lot size in India is 1. It means that you have to buy minimum of 1 share and in multiples of 1 thereof. So you can buy 34 shares of a company, you can buy 104 shares of a company, you can buy 119 shares of a company, but you cannot buy 100.25 shares of a company or 2.5 shares of a company. This is not allowed in Indian market. It is allowed in US markets, but in India you have to buy in multiples of 1. If for example for any derivative, let us say Nifty options, the lot size is 50. So you have to buy in quantities of 50 or its multiples. So you can buy either 50 options or you can buy 150 options, you can buy 300 options, but you cannot buy 320 options or 123 options. You can't buy in these terms. You have to buy it in multiples of 50. This is what is meaning of lot size. Even IPOs are issued in lots. So the IPO lot size can keep differing. It need not be fixed, but it is present in lot, so you have to buy it as one lot or multiples of one lot. That is the concept of lot size. The next important concept is concept of stop loss, also called SL. Okay, so stop loss, just like the name suggests, it stops you from big loss. So it is basically minimizing your losses. It is minimizing your losses. How it does this is that, let us take your maximum loss capacity is 500 on a capital of 5000. So your maximum loss capacity is 500, which is approximately 10% of your capital. So you are willing to invest 5000 in a company, let us say ABC company. You invest this capital. Let us say the share price was, CMP was at 100. You were bullish on the market, so you have taken a long position, but unfortunately the market falls. It turns into a bearish market and the price starts falling to 90, 80, 70 and so on. Your maximum loss capacity was 500 on a total capital of 5000. So you can afford to lose 10% of your capital. Once the CMP comes down by 10% to 90 rupees, you place a stop loss order here. We'll look at how to place a stop loss order later, but you place a stop loss order at 90 so that your maximum loss is cut down to only 500. Otherwise, if you didn't place the stop loss order here, the CMP of the share had fallen down to 70 rupees. So 30 rupees loss on a single share. So on a total capital of 5000, you would have made a total loss of 1000 1500 rupees, which is beyond your maximum loss capacity. That is the importance of placing a stop loss order. In equity, there is no chance of losing huge amounts in a single day, but even then, you will have to follow your stop loss strictly. In the F&O market, your entire capital can be wiped out to zero in a single day, not even a single day, in a small period of time like half an hour or 30 minutes. This can take place. That is the reason you need to follow your stop loss strictly. This is a trading psychology tip. You need to control your emotions and your greed and follow your stop loss strictly. So, blue chip companies is another term used for large companies that are financially well established, like Reliance Industries, TCS, Tata Motors, Asian Paints, Wipro, then you have Sale, Gale. All these are blue chip companies. What happens is they are quite stable in the stock market. Their CMP does not fluctuate much. So, like they say, volatility is not so much. Blue chip companies usually have volatility of this range. So, the potential to make huge losses in a single day is very, very minimum with blue chip companies. If you want to have a risk free investment, you can go with blue chip companies. If you want to make more profit, then blue chip companies are not your go to stocks. The next concept is the concept of market capitalization. Market capitalization is the total value of a company's share. So the basic formula is that market cap is equal to number of shares multiplied by CMP of the share or LTP of the share. So the total number of shares would be in lakhs to crores, and multiplied by the CMP will give you the total market capitalization of that particular company. The use of this market capitalization is to determine whether it's a large cap company, mid cap, or small cap company. Above 20,000 crore, it's a large cap company. Between 20,000 to 5,000 crore, it's a mid cap company, and anything smaller than that is a small cap company. You also have a classification for micro cap companies, which are very, very small companies. The implication here is that large cap companies, the valuation is very high, and most of the blue chip companies are usually large cap companies. Just like we discussed, the stability in large cap companies is very high and volatility is very low. The next concept is the concept of margin. So margin is available on intraday transactions in equity and in derivatives market. Margin is not available on equity delivery. So intraday equity is that if you square off your positions within one day, that is on T day itself, you buy and sell a company or sell and buy a company. It's called as intraday transaction. Equity delivery is that if you take delivery of the share, if you wait for the share settlement and you wait for couple of days after buying that particular share, so you buy it today and sell it 5 days later, it is equity delivery. You sell it 5 months later, that is also equity delivery. If you sell it 5 years later, that is also equity delivery, right? In equity delivery, you don't get to use margin. In intraday equity as well as in derivatives market, you get to use margin. So margin is a concept issued by your brokers. It is a feature that allows you to trade with only a part of the total capital required of total capital required. It is like buying a 5 lakh worth product with only 50,000 in hand. EMIs or loans, it is just like that. But margin here is that you get to spend only 50,000 for a 5 lakh worth product or worth shares, and you sell it off in intraday and when the total worth of the share turns 7 lakh, so the total money that you obtain after selling would be 70,000. Your profit would be 20,000. The concept of margin is to provide you easy accessibility to costly shares or costly products. It enables even small time traders to trade with costly products. The advantage is here that you get to trade with costly products, you get to trade with large quantities of small products also. You get to maximize your profit. With a capital of 50,000, you would have been able to buy only 5 shares of 1000 rupees each. Sorry, 5 shares of 10,000 rupees each. But if this 50,000 gave you a margin for 5 lakh, you would be able to buy 50 such shares and you can maximize your profit. This is the concept of margin. Margin is not available in equity delivery because the risk of any investor defaulting the broker is quite increased when the duration increases. That is why equity delivery does not provide you much margin. Circuit filter. This is a very interesting concept and it is to increase the safety of small time investors. So circuit filter is basically like barriers to your market. It brings down the volatility. A company, this is the upper circuit and lower circuit. A company share is trading within these limits, well and good. But once there is some news into the market saying that this ABC company is performing very, very well, what happens is that the share price starts shooting. It would have shot up to 100 rupees from a level of 20 rupees. So you would have made 80 rupees profit in a single day on one single share. Likewise, if a share trading at 100 rupees had fallen down to 20 rupees, you would have made a loss of 80 rupees on a single share in a single day. To prevent such huge losses and profit and to prevent such huge volatility, the market has introduced a concept of upper circuit and lower circuit. So the price, this upper circuit and lower circuit is valid for that particular day, and the price cannot move beyond the upper circuit and beyond the lower circuit. So this cannot happen, and the prices have to stay within these boundaries. This upper circuit and lower circuit is usually in terms of 5%, 10%, or 20% based on what NSE and PSE agree along with SEBI. And this 5, 10, 50, 20% is on the previous day's closing price. For example, if yesterday Wipro had closed at 1000 rupees and it had a circuit filter of, let us say, 10%, so today's upper circuit would be 1100 and lower circuit would be 900. This is easily mentioned in your broker's UI also, so you don't need to sit and calculate all these upper circuit and lower circuit values. This is applicable to a particular share. Now there is another concept called market wide circuit filter. Just like the name suggests, market wide, meaning for the entire market there is a limit, upper circuit and lower circuit limit. So the market cannot go beyond these. This cannot happen. It has to stay well within the boundaries. This is valid for one day. So the next day, based on today's closing, tomorrow's upper circuit and lower circuit prices will be mentioned. Now you can see here, you can find this on the NSE website also. This is the market wide circuit filter concept. So it is in a graded manner, 10%, 15%, and 20%, based on what time of the day the 10%, 15%, and 20% upper circuit and lower circuit are hit. The market stops for from a couple of minutes, ranging from 15 minutes to entire day. The market will stop. So you can no more place orders if the market stops in such conditions. With this, we come to the end of the fifth video lecture. Stay tuned for the remaining of the lecture series. You will be able to understand the entire basics of the stock market very well. Like, share, and subscribe to Stock Yatra and stay tuned. Thank you. Jai Hind.